Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. Here's a quick one for you. Wanted to talk about the Fed minutes. Fed minutes came out, discussed about the same stuffs that we've been hearing, slowing down the pace of the rate hikes. We know that it's priced in. They want to slow down. They don't want to speed it as much. But there was a very interesting point in the Fed minutes where it talked about that, hey, where is this rate going to head towards? What's that level? The minutes said there's a lot of uncertainty from a lot of Fed members who don't know where this level would be. And it's very interesting because it ties back to the Fed Bullard video that I talked about, where Fed Bullard was talking about the Taylor rule. And the Taylor rule basically says that if you get rates above inflation, you can bring inflation lower. Now, are they going to get rates above inflation? Inflation rate's about 7.7% year over year. What if inflation continues to go up higher? Will it go up higher? We'll find out, right? But if it doesn't, and you've got growth data really contracting and giving recessionary signals, then that should, if you think about it, bring inflation down. And if you keep rates at, let's say, 5.5%, 6%, wherever they want to go with this target. Because remember, they're not targeting pace anymore. They're not doing those big jumps according to what they're saying. Of course, anything can change. If inflation numbers come in hot next month, then sure, we throw that out of the window. But they're expected to slow the pace, but continue to raise rates at a certain level. And that level is where they're having uncertainty about, and where they're having a lot of discussions about. What is this level? Is this the restrictive zone? Is this not the restrictive zone? So it all depends where that level is. And again, like I was saying, it's very interesting because Fed Bullard was saying that the restrictive zone area tends to be 6 to 7% in interest rates. So either interest rates get to that level, or you keep rates at high elevated levels, 5+%, and then with the weakness of growth and the contraction in growth in the growth data, and which will seep into consumer spending, seep into higher unemployment rate, would eventually bring the inflation level lower. And if you get the inflation level lower below whatever target they're going for, whether it's 5%, 5.5%, or 6%, then you've got the restrictive area and you've got the Taylor rule working for you as well. Because now you've got rates above inflation. And when that happens, then according to the Taylor rule theory, that yes, you can combat inflation. And that's what they did back in 1980s. So it makes me think that, okay, for next year, with where the Fed is trying to go, because they left the door so open that, well, we're slowing down the pace, but we don't know where we're going to go. We could go higher, we could go lower, we could be average. I have no idea. And there's so much uncertainty. That's basically them saying they will continue to raise rates, not aggressively like they've done this year, but to do it and to keep it there. And we did hear them say to keep it elevated for a long period of time, because once they keep rates elevated for a long period of time, and if they decide to pause, if that inflation level starts to come down because growth is causing the inflation to come down, the demand crunch is causing inflation to come down, then yes, keep rates higher for longer and inflation comes down. Now you got the Taylor rule. Now you can say, oh, we're in restricted area, restricted zone. Now you can combat inflation. And of course, keeping rates higher for longer, remember the key word, higher for longer, will cause more pain, continue to cause pain in the markets, in the economy, which could cause that severe recession. And then you might get finally the Fed pivot, right? That Fed pivot that everyone's looking for. So the fact that the Fed's coming out and saying keeping rates higher for longer, slowing the pace, but still raising rates, might mean exactly that, what I just explained, and might hit the Taylor rule principle. It might work if the inflation comes down and the Fed would have done a good job engineering this Taylor rule principle, but not engineering a soft landing. That's not good for sure for anybody, and that's very hard and unlikely for the Fed to do that with the upcoming data that we're seeing right now. So let me know what you guys think. Leave a comment below, subscribe, hit the like button as well, and the bell icon to be notified on the next video, and I'll see you around. Cheers.